The company that changed how we travel now faces a major crisis. In 2008, 3 roommates sold cereal boxes to keep their lights on, but by 2020, they were worth more than the 3 biggest hotel chains combined. Today, the story has changed. From cities banning them to guests revolting against chore lists and hidden fees, the platform that promised we could belong anywhere is unwelcome in more places than ever. This is the story of how a $100 billion favorite lost the trust of the people who built it. Before they became tech billionaires, Brian Chesky and Joe Gebbia were 2 broke designers in San Francisco who could not pay their rent. Their 2008 idea for renting out air mattresses was failing hard, so they did something unusual. They designed custom cereal boxes labeled Obama O's and Captain McCain's, and sold them for $40 each during the election. They raised $30,000 selling cardboard and sugar, which convinced Paul Graham at Y Combinator to invest. He disliked the idea of strangers sleeping in living rooms, but loved the effort. That desperate cereal sale saved the company and started a massive shift in the industry. For the next decade, the platform felt special because it offered a way to travel that did not exist before. You were not just a tourist in a generic hotel room since you were staying in a treehouse in Costa Rica or a loft in Paris. It was personal, cheap, and authentic. The slogan, "Belong Anywhere," meant something as homeowners made extra cash while travelers saved money. The company grew fast enough to scare the hotel industry. By the time they went public in December 2020, shares soared to $144 on the first day. The valuation hit $100 billion, and they seem to have won. The live-like-a-local spirit eventually started to fade. Mom-and-pop hosts renting out a spare bedroom were slowly replaced by property management companies running 50 units like a dispersed hotel. We started seeing apartments stripped of personality and filled with generic IKEA furniture. This was no longer staying in someone's home since it became staying in an unregulated business. Investors bought single-family homes in quiet neighborhoods to turn them into short-term rentals, which broke the connection between host and guest. You became a turnover number on a spreadsheet rather than a welcomed guest. That culture shift created the anger that followed.
If you are finding this breakdown useful, please subscribe and turn on notifications, since we cover business collapses and market shifts every week. Next, we will examine the fee that changed everything. Then came the cleaning fees. By 2022, social media was filled with screenshots of receipts where the service and cleaning fees pushed a $100 nightly rate over $300. The price was not the only problem because the demands were often excessive. Guests paid high cleaning fees, yet were still expected to strip beds or take out the trash. One viral TikTok showed a host asking guests to wash towels despite charging a premium for cleaning. The value collapsed because paying more than a hotel to do your own chores made no sense. The company eventually updated the app to show the total price up front, but the damage to their reputation was already done. In late 2022 and early 2023, the term Airbnbust started trending. Panic spread through Facebook groups as hosts who bought properties at the market peak suddenly saw their calendars sitting empty. They received 0 bookings because there were simply too many listings rather than a lack of travelers. Everyone tried to join the trend at the exact same time, so the supply of rentals in the US grew faster than demand in many markets. New hosts with high-interest mortgages started facing foreclosure. The passive income dream turned into a financial loss for thousands of amateur real estate investors. While hosts worried about money, the guests started worrying about privacy. Reports surfaced that were far worse than a dirty bathroom. In March 2024, a family in Scottsdale found a camera hidden inside a smoke detector directly above their bed after their children had already slept in the room. This was not a unique case, since court records and police reports revealed thousands of customer support tickets related to surveillance devices. The company generated over 35,000 tickets concerning security devices in a decade. Although they banned all indoor cameras in March 2024, the fear remained and trust was lost. A hotel room might be small, but you know the smoke detector is just a smoke detector. The regulators finally caught up after cities complained for years that short-term rentals were stealing housing from residents. New York City enforced Local Law 18 in September 2023, which effectively banned almost all short-term rentals unless the host was present. The impact was immediate. Listings in the city dropped by over 80%, from 22,000 to barely 4,000. The short-term rental economy in New York disappeared. A black market emerged on Craigslist and Facebook, but the city became a hotel-only town for the average traveler, while hotel prices reached record highs. New York was a warning, but Barcelona took even stricter action. The Spanish city had struggled with over-tourism for years, as locals were priced out of their neighborhoods. In mid-2024, the mayor announced a plan to eliminate all 10,000 tourist apartment licenses by November 2028. The courts upheld the decision in 2025, which set a deadline for every host in the city. This strategy serves as a model for other places. Local governments from Lisbon to Berlin are watching, because if Barcelona succeeds in reclaiming its housing stock, other major tourist hubs will likely follow. A clear consumer shift was underway by 2025, because people were tired of uncertainty and chores. Hotels looked appealing again, even though they seemed outdated 10 years prior. You check in to get fresh towels and check out without needing to clean. There is no rating review where the host complains you missed the recycling. Business travelers return to loyalty points and concierges. The predictability of a Marriott or a Hilton became a luxury. The new service had become a hassle, while traditional hotels became the convenient option. Brian Chesky and his team knew they had a problem as the brand identity weakened. In the summer of 2024, they launched Icons to bring back the excitement. They built a replica of the floating house from the movie Up, complete with 8,000 balloons, and opened the X-Men mansion for overnight stays. These were marketing stunts designed to gain attention rather than just rentals. The goal was to remind the world that the platform could offer experiences that hotels never could. It generated headlines, but it did not solve the main problem, since most people just want a clean apartment that is affordable rather than a cartoon house. The company is not dead despite the bans and complaints. In 2025, they generated over $13 billion in revenue and remain profitable with plenty of cash. The era of rapid growth is over, though. The stock price has spent years trying to reclaim its 2021 highs, while other tech stocks rose. Wall Street treats them like a mature travel utility now, rather than a new startup. They are surviving by shifting to longer-term stays and exploring their own branded boutique hotels, which makes them similar to the industry they originally challenged. The biggest liability on their balance sheet is trust, because regaining community confidence is incredibly hard. Every time a guest finds a camera or a host cancels a booking last minute, the damage returns. The company responded by removing over 100,000 low-quality listings and introducing guest favorites to highlight the top homes. They are trying to organize the marketplace to prove they can be reliable. Millions of travelers who have had a bad stay or a misleading listing have deleted the app permanently. A major irony of the crackdown is what happened to the banned supply. Thousands of listings in New York moved to Facebook Marketplace or encrypted messaging apps instead of disappearing. These rentals have no protection or reviews. If you get scammed there, you are on your own. Regulators inadvertently created a group of unregulated and risky alternatives by trying to stop the large company. This proves that the demand for short-term rentals remains, but the safety net the platform provided is now gone for those markets. The company is leaner and more disciplined in 2026. They are no longer trying to be everything to everyone, and the days of charging $50 for an air mattress in a closet are over. The platform is becoming a premium product for groups and families who need a kitchen. The casual solo traveler has gone back to hotels, while the amateur host has sold their investment property. What remains is a smaller and more expensive marketplace. It is a better experience for those who can afford it, but the original promise of cheap travel for everyone has mostly ended. The history of this company teaches a hard lesson about industry change.
You can break rules like zoning laws and hotel taxes for a while, but eventually, reality catches up. Cities fight for their housing, while guests fight for comfort. The cereal boxes in 2008 represented creativity and a willingness to do anything to survive. Today, they need that same creativity to fix the problems they helped create, rather than just to grow. This journey from a desperate idea in a San Francisco apartment to a global company was remarkable. The platform is not going away, but the era of cheap and easy travel it created is history. We are back to a world where travel has rules and boundaries. If you want to see more stories about how industries rise and fall, make sure to subscribe.